It's time now, though, for Smart Charts with Abigail Doolittle, where we look at the timely topics through the charts with the street's top technicians. And Abigail, today, you're starting off with the S&P 500 technicals.
We are certainly doing that. I'm going to do that before bringing in our guest, because today on the sell-off, the S&P 500 down more than 3.3%. Its worst day since June 11. We do have some technical damage. Now, specifically, we are below the 100-day moving average. Typically, you really only look at the 50 or the 200-day moving average. But the reason that the 100-day moving average right now is important, you can see that it was support. That was the support that held on the September sell-off, and it was also the support that held on the June sell-off. However, back in February and March, not so much. So if the index cannot get back above that 100-day moving average, right around 3,300, a little bit above there, it's very likely we could see further declines because there is a bearish, potential bearish congestion pattern there, a classic double top, in fact, because the first set of buyers, they were more exuberant than the second set of buyers in that second peak. So that it gives you a clue of some bearish momentum, perhaps, which we are now seeing. So if below 3,200, the S&P 500 could truly get bearish. And on bottom, that RSI, the relative strength index, is declining, again, suggesting there could be some more selling ahead. So now, Doug Bush, CEO of ChartSmarter, is with us. Doug, thanks so much for taking the time. And before we go to a more constructive chart, Twitter, very quickly on the S&P 500 in about 15 seconds, what do you think?
Yeah, look, I just heard your commentary. It's below the 100-day. In my opinion, there's a likely course probably to the 200-day near 3130. That's roughly about 5% lower from here. If that were to happen and it holds, though, I think there's a good possibility that a double bottom pattern takes shape and we can resume the uptrend from there. But that's about 5% lower.
Well, that's certainly a more optimistic take, and let's hope that that happens. So now a truly optimistic chart, Twitter, and they, of course, report tomorrow after the bell. Talk to us about your chart here with Twitter and also the RSI in there.
Yeah, well, Twitter, as you know, the social media players are in focus with the congressional hearings this week. This one reports tomorrow, like you said. Chart-wise, it looks pretty good. It's comfortably above a weekly double bottom pivot of 46 that was taken out the week ending 10-2 in a pattern that was 28 months in duration. We know the best breakouts, Abigail, tend to work right away, so that's a good sign. Also, the greater the base, the greater the space to the upside.
Right.
Last week displayed great relative strength, up more than 10%, while the NASDAQ was down 1%.
Right.
My strategy on Twitter here, if one was long going into the earnings, hedge, but if one is flat and its reaction is disappointing, look for an entry near that 46, 47 level, which would be a retest of the double bottom breakout on the weekly chart, and as well on the daily chart, a gap fill from the 10-20 session.
Okay, and Doug, you know, I want to make sure that we get to your second chart because it's so interesting. The utilities right now, the defensive sector of utilities right now heading to its best month since 2003, perhaps a bearish tell. In about 10 seconds, talk to us about your chart of utilities breaking out against tech.
Yeah, well, listen, the utilities, like you said, Abigail, it's actually over the last 1 month period. It's the only major S&P sector higher. The ratio chart that you're showing there broke above a downtrend in early September against the NASDAQ. It was a shot across the barrel.
Well, we'll be certainly watching this. Doug Bush of ChartSmarter, thanks for joining us for Smart Chart.